In today's video, we're going to discuss one of the most confusing tax planning obstacles in retirement, IRMAA. I will give you 10 things to know about this costly penalty in order to help you make better decisions in your retirement. Let's get into it. First, what is IRMAA? IRMAA is a penalty tied to Medicare whereby if you show too much income in a given year, you will see increased costs on both Part B and Part D Medicare. IRMAA has 5 penalty zones, and as you can see on the screen, this can add up to thousands per year in additional expenses. It's estimated that more than 97% of retirees are on Medicare in retirement, and so this is a tax hurdle that can potentially affect a wide swath of retirees. But let's first get into talking about these 10 critical considerations. First, unlike most tax hurdles, IRMAA is a tax cliff. This means whether you show $1 or $10,000 over a threshold, you will have the full penalty. Because of this, it makes the most sense to fully use an IRMAA zone to your advantage. For instance, let's say that you find yourself $1,000 over the threshold. In this example, you will have the same $993 expense whether you show $1,000 over or $26,000 over that threshold. We would rather spread that $993 across a broader range of income than see a nearly 100% tax to just barely being over that given zone. Tax cliffs are the most costly types of penalties in the US tax system. Number 2, IRMAA is based on a 2-year lookback. This lookback exists because IRMAA is meant to adjust to inflation, and thus the government needs to observe a period of inflation and adjust accordingly. This 2-year lookback, however, creates one of the most confusing aspects to IRMAA. For instance, the 2024 brackets I showed earlier are based on 2022 income. Well, right now, you can do nothing to change your 2022 income. So the 2024 brackets aren't really that informative. As we sit here in 2023, we actually care about the 2025 brackets. This also creates a situation where you need to start planning for Medicare before you're on Medicare. If you sign up at the common age of 65, the income you show when you are 63 will determine your IRMAA costs at 65. If you begin Medicare later, the same idea applies. Number 3, we don't yet know what the 2025 brackets will look like. We can only estimate. Because of how IRMAA inflation adjustments are calculated, for the majority of 2023, we didn't even know what 2024 thresholds were going to be. It wasn't until the August inflation number came out that we could now calculate those 2024 levels. Now, this seems like a huge flaw in the system. How are we supposed to be able to plan around an unknown level? Well, with careful estimation, we can get pretty close. We know the minimum level IRMAA will be. We just don't know how high the thresholds might be pushed because of inflation adjustments. Because IRMAA is a tax cliff, I generally recommend being conservative on future inflation adjustments because a miscalculation could mean you fall off the tax cliff by just a few extra dollars and thus owe thousands in expenses. Number 4, know that IRMAA is a 1-year assessment, meaning that if you're subject to IRMAA in 2025, you'll only be subject to 1 year unless you break through IRMAA again. 2024 is based on 2022 income, 2025 IRMAA is based on 2023 income, and so on. In Roth conversion planning, this is important to note. Often a retiree's spending will not subject them to IRMAA because the levels are reasonably high. It's generally forced income in the form of RMDs or dividends and other capital gain distributions that will subject them to IRMAA. Once RMDs start and push you above IRMAA, they will likely continue to do so. Because of this, taking a 1 or 2 time IRMAA penalty earlier in retirement as you're Roth converting can often be preferred to taking an ongoing penalty due to things like RMDs and that growing forced income. IRMAA from RMDs is a continuous problem. IRMAA from a Roth conversion is a one-time problem. Number 5, IRMAA is based on something called your modified adjusted gross income, or otherwise referred to as MAGI. This is a starkly different number from your taxable income. Taxable income allows you to take the standard deduction, where MAGI does not allow this deduction. Tax-exempt interest, like muni bond interest, counts against you dollar for dollar in terms of IRMAA. Keep this in mind as it can get retirees with a large taxable account in trouble. There are, however, some deductions that are allowed with your MAGI. Above-the-line deductions like an HSA deduction is allowed. Retirement account contribution deductions are also allowed. Additionally, qualified charitable distributions or QCDs lower your MAGI. So if your RMD puts you $1,000 over an IRMAA threshold, it may make sense to QCD a portion of that RMD rather than get hit by that IRMAA cliff. Number 6, in tax planning, the easiest way to determine Whether taking an IRMAA penalty makes sense is to take the dollarized expense and transform it into a tax rate. This can be done by taking the added cost of the penalty and dividing it by the room you had in a given IRMAA zone. If you use that full zone, that would be. For instance, let's say that you were $1,000 over an IRMAA threshold and it costs you $993 in extra Medicare expenses. Since that $1,000 triggered this expense, you paid a 99.3% marginal tax rate on that extra $1,000, and that's in addition to the federal and state income tax rate. That $1,000 cost you way more than it actually helped you. If, however, you spread that $993 across a full IRMAA zone, that marginal tax rate drops. Let's say you break through a second IRMAA zone and you live in Michigan. If you're fully using this zone correctly, there's about $32,000 worth of room in this zone. The cost associated with this zone is about $1,500, which works out to about a 4.7% added marginal rate. Add this together with the federal and state income tax rates, and you would be at a marginal tax rate of nearly 33% for this given retiree. Assessing whether it makes sense to pay this rate is much easier than other calculation methods when you look at the long-term tax implications. Number 7, know that you can appeal IRMAA if you have a qualifying event. There are 8 qualifying events listed on the screen. The IRMAA appeal form is Form SSA-44. Let's say that you're in a situation where you work until age 65, retire, and then immediately go on Medicare. While you were working, let's say you made enough that it would have pushed you through certain IRMAA threshold zones. You don't have to accept this IRMAA penalty. You can, in fact, appeal this IRMAA charge because your situation changed greatly. You qualify for an appeal. When you stopped working, that income that pushed you over the IRMAA zone stopped as well. Because of this, you shouldn't be charged for a Medicare penalty, and the government agrees. But they won't reverse that penalty unless you appeal. Number 8, sometimes it can make sense to strategically take an IRMAA penalty. Let's say you just retired and you're 63. You know that RMDs are going to be an issue in your situation, and you need to perform large Roth conversions to avoid said RMDs. But you're nervous because large Roth conversions will subject you to IRMAA and thus increase costs 2 years from now. Well, if your birthday is in the back half of the year, let's say November, know that your IRMAA costs will be far less in the first year of filing because you will only be on Medicare for a very short period of time. Therefore, it can make sense to take a penalty because it will be 1/6 of what the penalty would otherwise be if you were on Medicare for the full year. So depending on when Medicare starts in your situation, not all IRMAA penalties are created equal. Another time it can make sense to strategically take an IRMAA penalty is when one spouse is subject to IRMAA, but the other is not. Say you're 65 and your spouse is 60. Because you're married, you will be subject to the joint IRMAA brackets, but only one of you will have the IRMAA penalty if you break through thresholds. This lowers your marginal tax cost of taking an IRMAA penalty versus if both of you were subject to IRMAA. As you can see, the marginal tax cost cuts in half. Again, when we think about breaking through IRMAA due to Roth conversions, you'd rather break through IRMAA when only one of you is subject to the given added cost versus waiting until both of you are subject and have that cost. Then finally, consideration number 10 is the widow trap. When you're married, IRMAA is more forgiving. In today's dollars, you would have to show over $200,000 of gross income to hit a penalty zone. That all changes when one spouse passes away because the survivor goes from the joint brackets to the single brackets. Say a couple had $150,000 of gross income when both spouses were alive. This is a high amount of retirement income, but would not subject this couple to IRMAA. One spouse passes away, and the same $150,000 would subject them to 2 IRMAA levels. Now, in many cases, your income will go down to some extent at the death of a spouse because the lower Social Security benefit is lost. But other income like RMDs or dividend and capital gain income generally stays pretty steady. This means the loss of a spouse can accelerate costs associated with this Medicare penalty zone. Now, hopefully these 10 considerations helped increase your understanding around this confusing tax hurdle. As you can see, it's a complicated topic. The toughest aspect is not knowing what the future brackets will exactly look like. Click on this video to learn how exactly to calculate out and avoid IRMAA the right way. This video might just save you thousands. Always remember, you don't need more money, you need a better plan. Thanks for watching, and I hope to see you in the next video.